Hi, my name is Stuart Barron. I'm Head of Research for Cushman Wakefield Canadian Markets, and I'm pleased to be here today and talk to you about the Greater Toronto Area office markets for the second quarter in 2012. I think that at a high level I've captured the second quarter in three major observations. First, the recession of 2008 is now 3.5 years behind us. Normally, in a cycle between the 3 and 4 year mark, we're at the peak of the vacancy cycle after a recession hits us. So downtown Toronto would be somewhere between, say, 10 and 14% vacancy if we didn't know any better. But the reality is that the second quarter observation, which is extremely interesting, is that vacancy in fact fell to 4.5% from 4.9% 1 quarter ago. Now 4.5% is enormously tight, but what drove it is even more interesting. Demand and absorption was over 280,000 square feet over the second quarter. Now anything beyond 250 is considered a very strong market. What we were expecting, of course, is sort of more modest demand strength, somewhere between 75,000 and 125,000 square feet for downtown Toronto. So really we more than doubled what our expectations were, driven by the same culprits: the banking sector, other financial services, legal sector, and the technology sector. However, the bottom line seems to be that what's coming out of the woodwork is expansionary growth and confidence at a tenant and a company level with respect to future profitability. Now, why is it a surprise? A little bit because of what we're seeing globally right now, particularly with China weakening economic conditions, with India complaining about downgrades in economic conditions, with the European debt crisis, and with cracks in the lining of the U.S. economic might, the engine south of the border. We really expected more modest demand strength, and yet we continue to see buoyancy in demand in downtown Toronto. Now, the second observation is just as interesting. The most significant transactions that happened in downtown Toronto had no impact on absorption at all. Marsh McLennan leased 220,000 square feet at 120 Bremner. Now this is GWL and BCIMC's new 700,000 square foot tower that's going to rise by the fourth quarter in 2014. Also SNC Lavalin, for instance, leased 75,000 square feet in the same tower. So these are future transactions driving up new developments in downtown Toronto. The Globe and Mail leased 211,000 square feet, kicking off another new development in the west side of the financial core. That's a 430,000 square foot building, LEED Gold, to rise in 2015. Additionally, very recently, Deloitte locked down on 430,000 square feet at the new Bay Adelaide Centre, the only one of the new developments, and that's a 900,000 square foot LEED Gold tower that's going to rise within the traditional boundary lines of the financial core. Now that's really exciting news. It speaks to confidence, it speaks to future profitability, and at a high level it tells us now that over 3.7 million square feet of new developments are going to rise in downtown Toronto between the third quarter of 2014 and the third quarter of 2016. That's going to make those years riding right through to 2018 extremely interesting in downtown Toronto. The real question mark, as interest rates pick up in a few years' time, will the demand be there to fill up these new towers? Now the third observation relates to the suburban markets. Right across Canada, interestingly, what we saw in the second quarter was a pullback in demand. If you remove Alberta, which of course is driven by profitability as it relates to the oil industry, overall demand strength was negative across suburban markets. The GTA was the same way, with negative 100,000 square feet in absorption across the Greater Toronto Area suburban markets in the second quarter. There was some strength in the west, there was greater weakness in the east, and there was some weakness in central north Toronto suburban markets. But the reality is that there's a pullback, and it doesn't surprise us because we know that the global economic conditions are much more sensitive towards and impacting suburban markets than central markets, and the GTA suburbs is no exception. So what we're seeing is a tremendous amount of densification. We're seeing consolidations where multiple premises locations are moving into a single location and displacing space into the market. So even when there's growth, there's actually neutral impact on overall rental areas leased, and this is holding vacancy fairly level. The good news, suburban markets are between 9 and 10% vacancy rate, and that means when demand picks up, which is likely to happen in the first quarter of 2013, we're likely to see some fairly quick momentum gains from a rental rate perspective. So if you're an asset manager, hang on. Thanks for joining Cushman & Wakefield's Market Watch for the second quarter 2012. I'm Stuart Barron, and I look forward to joining you next time around.